The limited partner shares in the potentially outsized returns of a well-planned and executed investment, but as a passive investor, and has the maximum leverage on their most precious asset, their time. And that is why we're here together. 90% of the millionaires out there built their net worth with real estate. However, 0% of the billionaires are hands-on managing the real estate assets because there simply isn't enough time. My name is Jake Wiley, and for the past 16 years, I've been investing in real estate, and I've learned a thing or two. But the most important lesson is how to leverage the expertise and time of others to maximize your investment potential. Welcome to the Limited Partner Podcast. All right, welcome to the Limited Partner Podcast. This is going to be an action-packed episode. We're really covering some hot topics that are out there in the real estate market. There's a lot going on, and to kind of timestamp this for you, it's June of 2023. The Fed has just announced a pause. There's geopolitical issues with Russia and Ukraine. We've had emissaries going out to China to see if we can bring the tensions down. But there's a lot going on. But really, some of the headline is still office, right? So what is going to happen with office? And I think in this episode, we're going to get into some of the things that are out there in the marketplace that I think are going to have a pretty significant impact. So in this episode, we're going to cover banks are getting out of bad loans, right? They're finally starting to write these things off. And what I mean by that is, they've got loans for multifamily, for office particularly, but really in commercial loans altogether that have been underperforming or really should have been sent to the servicer as special servicing, and they haven't done it yet. And they're starting to do that. Houston, which actually had these, this blip of positivity in terms of return to the office, really kind of through the pandemic, and they really touted their horn. I think reality is starting to set in, and they're starting to come back to where things were before, or really more in line with the rest of the country. I think that's a really good marker of where things are going to be in the office market. And then we're going to talk about Starwood and their decision to sell off a bunch of single family rentals. And the reason I want to bring that in for the show, obviously, is that, there's been a lot of discussion, at least by me, and my thoughts on what's going to happen with office and how that's going to impact the, overall commercial market and then potentially the single family market. And we're starting to see firms selling off significant single family ownerships. D.R. Horton just announced, multi-billion-dollar deal to sell off tons of their homes. And Starwood is actually selling some of their homes. Interestingly enough, they're all going to the same buyer. But, I think that's really going to factor into the marketplace. And it's going to factor into, basically your homeowners, right? Like your actual real estate. And then we're going to talk about Goldman's, they're starting to write down their commercial loans. So you see how this is all starting to play out. So it's going to be a lot. There's going to be a lot in this episode. Hopefully you find it interesting, but stick with me. But I guess before we get into it, just a little bit of an update on me and how things are going, what's happening. It's late June here of 2023. School has just ended. I've got 4 kids. And they're all kind of back in the house and camp. And I mean, it's been a transition. I know I've done this before, but this summer seems really, I guess, because of the work from home, it seems really intrusive in a sense. And I don't mean that in a bad way, but just kind of getting adjusted to the kids being back. But first week they are out, we took off to a lake in North Georgia. We spent a week at the lake, and I made the, unfortunate decision that I was going to kind of work through it. I didn't have a whole lot to do. And it was just easier just to say, hey, I'll take the emails, I'll take the calls as they come up. And, really came to the realization that I was just half there. I was half, answering my work stuff and then half with my family. And it was, honestly, it was pretty frustrating. I was frustrated with myself, not with anybody else, because I'm tired of being half there, right? Half present. And, this is really a lot of the genesis of the Limited Partner Podcast is to give yourself the financial freedom to be fully where you want to be and fully there everywhere you go. And it was, it's a mistake on my part. And, I'm kind of glad it happened because it really just reinforced what we're trying to do here is to build passive income streams to set you free. Right. And that's the goal. And I can never be fully present because there's always either a call coming up or, I was thinking about something and I needed to respond. when I was trying to take care of these work things, I was like almost like frustrated. I'm like, I just wish this wasn't here, and kind of moving back and forth. So really hit home. I think that, I want to bring that into the show. I want to bring it into the show a little bit more, is that the intent here, right? Like, why do we want to be limited partners? Is because we want to be passive. We want to be hands off, and we want it to give us that space and the freedom. And I think, in this show, we're also going to start to see, I'm going to start to expand it a little bit more too, and open it up to some other ideas. Because for me, I have other ideas of how I want to do that. And it's not just being a limited partner in real estate. It's also creating some other passive income streams. And I've got other channels out there that focus on that. And I've learned some lessons. I might start bringing some of that into the show as well, because I think, there's probably a lot of you out there that are just like me, that are saying like, yeah, I want to be passive, but I also want to have a say in what we're doing. I think there's pros and cons of each. So more on that to come in the future, but hopefully that'll resonate. It might just be a total brick. We'll see. But let's get into the meat of the show. So I think banks are finally in a place where they're starting to say, hey, we can't just keep kicking the can down the road on these bad office loans. RXR, so they're a real estate firm, and they're going to hand back to the keys to 2 office towers due to the struggles, and there's been this quote unquote extend and pretend strategy for some of this distressed property, really hoping that office was going to come back. But, like we'll get into later in the show, and the reason I brought in, this article on Houston and their struggles, I guess, with their early signs of positivity that more people are going back to the office. And I think now it's starting to get closer to the national average, is that, I think there were glimmers of hope, or people thinking that maybe it was going to turn around and it was going to kind of go back to the way things were. And then it's no longer the employees market where they can kind of decide what they want with the economy changing a little bit. I think there was a hope that, the employers would start to have a little bit more control. But frankly, like, even if that's the case, I think it's short-sighted, in that, like, what most of the really successful companies out there are doing, in the conversations that I'm having, is that they're actually focused on bringing the right people in, and the right people don't just happen to be in the market that you're in. And that's a big shift. And that's been a big transition point for a lot of leaders of the companies, is that like, yeah, hey, we want to be in the office together and powwow, but they're really finding that, like, when we do our searches and then we just open up our searches for, key positions, those people can be anywhere. Instead of saying, hey, we're going to try and, convince somebody to leave, a place that they love and go somewhere that they don't, or, maybe don't think they're really interested in, they can let them stay there. And that's the reality now. So the banks are now having to face that reality in this quote unquote extend and pretend strategy of just kind of keeping these distressed properties on the market. They're having to move it off, right? So the secondary market for distressed office loans is currently a big concern, about the sector's viability and profitability. In regional banks, like, this is where it's really starting to become a thing, is they're starting to face cash crunches, right? And we've all heard the stories about SVB, Signature Bank. These banks, they've put the money out there. They don't have enough money to cover the deposits and people's demand for deposits. And I think that, the big banks are pulling folks back in, or, getting people to move their money to the big banks, which is creating further issue, right? For these regional banks. And it's a struggle. And ultimately, a lot of these regional banks are where most of the commercial real estate loans were. So, I think they're finally starting to deal with the issue. And I think that there's not really a coming back from an office perspective. And I think what that's going to do is it's going to create this kind of trickle down effect across the entire commercial sector, right? Because if banks are not going to be able to lend, or they're having to take these losses, and I think that there's going to be some more bank failures as a result of this, then it's going to be an issue, right? And it's not going to be, you can't just silo it in office, even though, multifamily and self-storage and all those things have remained very strong. It's going to happen, right? And then 2, I think what's also important as we get into it later is we talk about the single family market, right? There is a lot of corporate owners of single family market players that you probably didn't fully appreciate. And like the number of corporate owned, or basically investor owned single family real estate is actually significant here in the US. And we're starting to see, major players take these properties and get them off their books because they don't think the play is there. They don't think it's going to be the right return profile for their investors. And so what does that mean? It means that there's going to be some decline in values and that we're going to have to deal with that. Kind of moving on, like even further in this story. So Fifth Third Bank is just another lender that has recently decided to just completely withdraw from office lending. And, it's part of this broader trend that we just got, done talking about, but other banks are doing this. And like as banks are starting to pull out and saying, hey, we're not even going to lend in this sector, right? That's going to create issues. Now, maybe some of the agencies can pick up the slack and the government's going to pick up the slack. But some of the conversations I've had with some really large players in the market is that they're saying, ultimately, like the market is meant to be efficient and it's not to be every time there's distress that the government just comes and bails out. So I don't know where this is going. And I know on other episodes, I've actually encouraged you to reach out to your state senator and basically say, hey, you guys need to take your blinders off. Like this is an issue. Like forget like your party politics. Like this is something that's going to affect us all. There's a lot of players out there that say like they're not expecting the government to jump in and save them, but it could also turn pretty bleak pretty quickly. So I think this is something to watch. But like you see these headlines and these trends, and part of the reason we're having this show is I just want to bring awareness to the fact that banks are categorically staying now. Like we will not lend to the office sector, right? And it's not just one bank. There's multiple banks that have already said that. Fifth Third is just the latest. But that you cannot put your head in the sand and just assume that that's not going to have a trickle down effect. It's going to have a big effect. And that's the way of the world, right? For those of you out there that are kind of watching this market like I am, like just keep your eyes open, watch what's happening. I think that there's more to come. But, with that said, I think, also we've already talked about this a little bit is that, Houston kind of through the pandemic was really touting their back to office, right? Like they had folks coming back. It looked like it was a real plan. They had everything together and like, Houston was setting the world on fire and showing that like you can do this. But we're starting to see that it's really normalizing with the rest of the marketplace. And that's something that's really important to watch because like when you think about the office environment and you think about what the banks are doing, right? They're saying that we're not lending here. And then you're seeing that even the glimmering, rays of hope that we had, in Houston kind of touted this, like it's not holding true. And the marketplace is also, I guess, such a place right now where I think there was a lot of hope that with kind of changing from an employee's market to an employer's market, that there would be the ability to dictate, where employees are working and like bringing people back in. And I know we're seeing that. And I think we're seeing in certain cases, employers are saying like, hey, like we want you back 50% of the time, or we want you back 3 days a week. But what's been really interesting is that when you actually dig into that just a little bit further, you find that they're not really, most employers are not enforcing that right now. Yes, they say that. And yes, that's what's out on their, kind of the PR. And yes, that's what they're kind of telling to the marketplace. But the reality is that there is not a lot of employers right now that are really enforcing that. And, I think there's a lot of employees that are just saying like, I don't know why, like I would go back and I don't need a place to go back to do individual solitary work. Some people love going back, right? And I think that there's, situations where, like we talked about at the top of the show, like sometimes it would be nice to have an office, right? There's points and times where right outside of my office, I've got 4 kids like running around and then all their friends in the house. And it's a little bit distracting and it's not super conducive to work. But at the end of the day, like would I say, hey, I'm going to go back to the office, 3-4 days a week for that? No, I wouldn't, right? Like I'm going to have to work through how to make this more efficient at home. There's a lot to unpack there still, but I think that it's not what we hoped it would be, or, I don't even say that I would hope it would be, but I think that the market has been trying to say people are coming back and they're going to come back and that's going to be it's going to be fine. And we'll be able to save these office buildings. And I think that like if you read, between the lines of all the stories that we're talking about here, you're going to find that the thread is that it's not, right? It's not working. You've got, banks finally saying like, we're going to have to do away with this extend philosophy and hope that it's going to come back. You've got banks saying that like they are no longer writing loans across the board for specific real estate assets. And you've got markets where initially the signs looked really positive and they're, touting their horn that like it can be done. And it's all kind of coming back to the fact that it's not really working. So that kind of brings us full circle back to the whole single family aspect of it as well. So Starwood's REIT is, considering selling more than 2,000 single family homes. And what they're saying is part of their strategy to focus on core markets and maximize value for shareholders. And, for a long time, like the single family rental, so SFR, if you ever hear that term, single family rental, was a really hot trend. And it's a really interesting one in that, like, I've owned a bunch of single family rentals and it's very inefficient, especially if you compare it to multifamily. Where you've got, hundreds of units, on-site property management, the cost per door is lower, taxes, less roofs, like you name it. Like there's a lot of efficiencies in kind of this multifamily. So, when the single family boom really started taking off, like it was a head scratcher for me because it's like, I just don't understand like why you would want to do single family when multifamily just seems like it's a lot more efficient. And what a lot of these larger players have found is that when you get to scale in a single family rental market, like there is the possibility to do it. And then two, you're dealing with a slightly higher income or potentially higher income. You're looking for folks that are willing to pay more to be in a single family home versus an apartment. And, or you just find people, like I'm a great example of this. We've been investing in real estate and we move through a bunch of different properties. And like in most cases, I cannot find an apartment that will fit my family of 6. Like it just doesn't work. Like they're not out there. It's really hard. Most is 2 bedrooms. Even a 3 bedroom is super tight. So there are people like me that just want to be in a home. And there's a lot of people out there which surprisingly don't want to own a home. Like they do want to rent and they want to be in a home. So it's kind of like this parceled out American dream. And, the market went crazy. You've got some of these large players that over the course of the last decade have basically gone from 0 to over 100,000 single family homes in their rental portfolio. And they've been able to achieve this scale in these various markets where they work, where it's more of a proxy for multifamily. It's not necessarily on site, but you've got centralized management, you've got property management, you've got the ability to go out there and get into these homes. And, what was really interesting is a lot of these were bought, even throughout the process of COVID, because these funds, they were out there, and you probably heard this a million times, like there's a ton of dry powder, but a lot of times you got to activate this dry powder. You can't just sit on the sidelines forever. You actually got to put it to work so it can return for the investors. So, there were times where, every opportunity that they were snatching up like single family homes. And then you had like the Zillow fallout where they tried to go out and, start acquiring single family homes themselves and then realized it didn't work in their business model. And then they had to liquidate a bunch of them because they overpaid. But when we talk about the housing shortage across the country, like this corporate investment, this investor in strategy on single family homes put a lot of pressure on pricing. Right? Because like houses just weren't sitting. So you've got the retail buyers, like the average person that's out there trying to buy homes. And then you've got these large investors that are out there looking to put money to work and buying up large swaths of homes and taking them off of the market, which in turn created pricing increases. And what's interesting is that the values of these portfolios for a while looked amazing, right? Because of the value of the properties were going up because of the lack of inventory. Now we're in a situation where we're starting to see some of these larger players that are looking at their portfolio and saying like, hey, this might not work for us. Or we're starting to see values of homes stabilize with these higher interest rates or even come down a little bit. That's going to have a significant impact on a lot of these portfolios, and they're starting to liquidate. So it doesn't mean it's going to be a universal thing. And it turns out, it seems like there's always a large buyer that's willing to buy large swaths of properties. But you got to believe that these properties are selling for discounted values to move them en masse. So for those of you that own a home right next to one of these properties that has recently been sold or is about to be sold, that's going to be a comp for you, right? And that's the reality. And I think some of these larger players that are kind of moving in and out of these markets can appreciate that like, hey, we can take a loss here because we're going to turn around and take this cash and move it into something else. And I think that that's something that like most of us as homeowners don't really fully appreciate, is that if my core business model is buying multifamily and I know that market, I've got relationships all over the place, and I've got a portfolio of some single family homes over here, And the single family homes are not necessarily my core expertise, but they've kind of been working for me in the past. But now I see that like we might start getting outside of our comfort zone with these properties. Then I may sell them at a loss and say, look, I'd rather take the cash because I can use that cash and that opportunity to reinvest back into my core market where I'm seeing discounts of maybe 30%. So like maybe you're selling the single family at 10, 15, 20% losses, then to take that same money and invest in something that is your core market that's got a 30% upside. That's actually happening right now. What that means for the home buyers market is that there is a potential that if these sales and these large blocks of homes are coming off corporate books, investor-owned books at a discount, because they perceive that there's opportunity in the marketplace, it's going to impact basically the single family market, which is where a lot of us have a lot of our money and a lot of our net worth. So as you're thinking about the market, I think it's just worth noting that like one, if you've got a commercial meltdown, which is possible because of the office market, you've got banks saying we're getting these loans off our books, and you've got banks saying we're no longer writing for the office market. Like there is going to be a trickle down effect across the entire real estate market. And then now you've got large players that are liquidating large, swaths of single family properties in the marketplace. Like you got to believe they're selling at a discount. So you just got to be on the lookout for that. And then, kind of maybe rounding out the show here, I want to talk about Goldman Sachs is now kind of writing down the value of their commercial real estate loans. So like really no surprise here. But Goldman Sachs has just announced it's going to report impairment on its commercial real estate loans in the current quarter. And these impairments are a result in the ongoing challenges faced by the CRE sector, particularly due to the COVID pandemic. But it's, just what's happening in the market. And the bank's decision reflects a prudent approach to managing its loan portfolio and addressing credit risk. But at the end of the day, they have to do it, right? Because when you're valuing from an accounting perspective, from a reporting perspective, like you got to go out there and you got to look at these loans and you got to look at the real estate that's the collateral for these loans. And everything that we've talked about on this show is starting to say like, well, yeah, we know that the values are going down. And therefore, like the underlying loans are going to have to reflect that as well. And, Goldman Sachs is making this announcement, like that's going to be in their quarter update. They're just really one of the first that are going to have to start sharing this knowledge, or not really sharing the knowledge, but the information of these CRE loan portfolios. Like they're taking hits. So again, like this is just a little bit more information kind of sharing like how all of these things are working together. And again, it's not really a surprise when you think about it, and not in isolation, but it's out there. The news is out there. Buyer beware. I think the opportunity, especially for a lot of us, is to look at this and say, okay, well, we see the loans, the values of the loans are coming down. We see that, some banks are not even taking it. We're seeing that banks are now finally saying like, we can no longer do this extend and pretend that everything is going to bounce back. That means that there's going to be a lot of property on the market in the relatively, near future that is trading at a significant discount of what it was, especially over the last couple of years, but even pre-COVID. And I think there's the opportunity, and you just got to be smart, right? And I think that, one of the things that is always frustrating for me, or is not really frustrating, but you see people out there that have money and they want to go invest, and it's like burning a hole in their pocket because they feel like the cash is, it needs to be invested and needs to be working. But, you got to be prudent on the timing of that. And I think, from even, buying a home right now, like when we see large swaths of the single families coming in or trading hands probably at a discount, that's a comp, like you're going to start to see the values coming down kind of across the board. Like, I can't predict how big it's going to be. I know the office sector is going to be massive, and I don't know how much that's going to impact the rest of the market, but it will. So, be willing to look for those opportunities. And they're happening, right? Like they're happening now, where these banks are saying like, hey, we've got to do something about this, and we've got to move this property. And they're willing to move it quickly so they can get it off their books. Because like once they've made the decision that it's no longer a performing asset and they're no longer extending the terms, it becomes a liability and they've got to move it quickly. So having a good relationship with, a GP, a sponsor, somebody that's familiar with the assets, that sees these things coming in, is, it's going to be paramount here. And kind of like we mentioned above in the Starwood story, they're looking at the marketplace and saying like, single family was not necessarily really our thing. It was an opportunity. And we saw the marketplace kind of gravitating to this opportunity. We jumped in. Now we're looking at it and saying like, that's not our core focus. Like we're going to get back to basics. We're going to invest in what we want. And we see opportunity coming that way. You should be thinking about that the same way is where do you want to focus? Where do you want to be? Anyway, that's been a lot of information. I think there's definitely some hot topics. I think it's really interesting right now. I'm still bullish about the opportunity to come out of this kind of turn way better than it ever were. And, like I've said a million times on the show, real wealth is made in the downturns, right? So you can look at this and feel like it's really gloomy, or you can look at this and say, okay, the opportunity is coming and I am ready. So that's my suggestion is, be optimistic about what's coming. I think that, the large players can set an example for us is that there are going to be times where you have to take a loss so that you can move forward, right? And, just be thoughtful about that. Just because you got a property that maybe is going to take a loss, like you can spend the next 10 years, waiting for it to bounce back, or you can say, look, I'll take the loss now. We're going to move on to the next opportunity. And hopefully we're buying it at even a better discount and we're moving forward. And that's kind of how it's done. And that's what the big players are doing. And I recommend that you look at it that way too. And, yes, it might be tough. It might be a little bit of doom and gloom. And then, strangely enough, there's still a lot of positivity in the marketplace that I think is unjustified, right? And I think you got to be skeptical of that as well, right? So just have your eyes on the prize. I think like me, if you're following the news and you see what's happening and you kind of read between the lines and see what the general trends are, you're going to be able to spot the opportunities when they're coming up, right? Nothing's going to zero. I think the underlying economics of the economy are still very strong. I think that we've just got to get this kind of bump out of our system, and office is going to be a big one because there's just a lot of space that'll never be used again in the office capacity, or especially in the existing buildings. And just one quick stat is that, a lot of the major buildings in New York City were built in the 60s. Big boom, right? Coming off World War II, a lot of those office spaces were built like nobody wants to be in that stuff anymore. They're moving to the Class A, the new big glass towers that are coming online. That's a good visual for you. Several years ago, good interesting stories, the Chrysler building, right? The one you always see Spider-Man hanging off of in the movies with the kind of the eagles on the side, sold for $100 million, right? And it had a lot to do with the lease of the land underneath it. But it also had a lot to do with the fact that the building is just old. And that's not the way the marketplace is going anymore. So look at it. Hopefully that helps kind of paint a picture of like what office is up against and why there's going to be a transition here. But hopefully you see that the opportunity is that like one, population is not going down and, real estate remains to be scarce. There are places where people want to be and there's opportunity. The economics of the underlying economy are still good. So position yourself, be ready, and be open-minded to opportunities when they come your way. This period here is going to change a lot of people's lives for the positive that are ready for that. But anyway, that is it for this week. I hope you enjoyed it. Love to get your comments, whether you agree with what I said or you don't, or you disagree, that's fine. Let's start a discussion and we'll talk soon. I hope you've enjoyed today's episode, and I'd actually love for you to contribute to a future episode. If you have a question you'd like answered or a topic or a guest to bring on the show, please email me at jake@thelimitedpartner.com. Now I realize there's a lot of lingo that's thrown around on these shows, so I've created a cheat sheet for you with the top 26 terms that come up most often. Head on over to thelimitedpartner.com/lingo for the list. Enjoy, and we'll see you next time.